I'm Scarlet. This is ETF IQ, where we focus on the access, risks, and rewards offered by exchange-traded funds. Another former Fed official weighs in on the chaos in the repo market. What's the trickle-down effect for the ETF industry? DIY financial literacy. Tyrone Ross and Phil Back connect the dots between their new financial education program in Detroit and ETFs. And food fight. We serve up the new vegan ETF to show you what's inside the animal and climate-friendly fund. Now, love them or hate them, ETFs are here to stay, and we watch their flows to get a signal on broader market trends. Etf Balchunas is here to show us where the money is moving.
Thank you, Scarlet. We talked most of the year about the rush into fixed income ETFs. Then the last month, it seemed like, oh no, equities are taking over. Now it's a bit of both. There's a tug of war going on in the market, and it's reflected in the flows, and you can see it very quickly. You've got the S&P ETF here, and you've got tech here, right? But then you've also got gold and treasuries in the middle. So that's mixed signals there. People are definitely have different opinions on where the market is going right now. And the same thing is reflected in the outflows. If you look at the outflows in the past week, we're going to ignore all of the V tickers. That's a rebalance. So let's look. We got SHV. That's a treasury ETF, short-term treasuries. But then there's small caps. Remember, that was big. There's an S&P 500. There's a Dow ETF. There's more treasuries. So it's really intriguing that you have people buying the equities and treasuries and also selling equities and treasuries. So this is an unusual kind of situation. We'll see who wins out over the next couple weeks. Let's look at fixed income ETF flows this year, because this to me is probably where there's the biggest maybe regime change going on. Fixed income dominated all year. This is this line here. This is the treasury portion of fixed income. What's happening is people are getting out of treasuries, and that's weighing down fixed income, which is really underwhelming compared to the rest of the year. And equities are starting to take over. But Scarlet, I'm not ready to call this a regime change because there are people now buying gold and treasuries again.
Yeah, we've had several head fakes this year already. Let's bring in Tim Urbanowitz. He is Director of Fixed Income Strategy at Invesco, along with Rachel Evans, who heads up ETF coverage for Bloomberg News. Tim, Eric just showed us the shifts in fixed income flows. What are you seeing, and what does it tell us about investor conviction on where interest rates are headed?
Well, I think you're seeing a very challenging backdrop out there globally. If you look here in the U.S., you have a 10-year that is off year-to-date lows, but still not by much. If you look in the developed markets, you have the average yield on non-U.S. dollar sovereigns that's back above zero, but again, not by much. And then if you look at credit spreads are stubbornly tight. So it's a very challenging backdrop, but with that, we are seeing investors find different pockets of opportunity. So one of those areas would be in corporate credit. If you look at investment grade market, what you're seeing there is you're still getting a nice bump over treasuries in that market. But at the same time, we're also seeing this global search for yield really reignite the bid from foreign investors into corporates. So if you look at the bullet shares corporates from Invesco, which really gives us a nice snapshot of the yield curve in corporates, what we're seeing is a lot of that flow is going into the short end to try to get access to that narrative, but at the same time, reduce any mark-to-market risk.
Okay, so people are looking for yield, Rachel. Eric described a mixed bag when it comes to themes overall. What are you seeing in equities? Because there was a bit of a resurgence into equity ETFs this month.
Yeah, I think Eric really classifies it correctly when he describes it as a tug of war. That's very much what we're seeing in kind of fixed income side and in the equity side. We're seeing a bumper month for equities. I think about 26 billion already kind of gone into those sorts of funds. But you're really seeing it going to interesting places. So you're seeing value have a resurgence, but growth is doing quite well. You're seeing technology stocks doing pretty well, but you're also seeing real estate, which tends to be more of a kind of defensive play, doing well. So I think there's a real kind of split between those that kind of like want to go back into those yield-seeking, more kind of sort of equity-like assets, but then also those that are doing so a bit more cautiously.
Speaking of that mixed bag, BKLN is almost like a mixed bag within a ticker. It's taken in a lot of flows, the senior loan ETF. Now, typically, it's floating in high yield. High yield does better when rates fall, but floaters do better when rates are rising. This one does both. So where are the flows? What are they seeking out with this thing right now?
Well, it's been really interesting to see. If you look at just traditional high-yield ETFs, these products have seen inflows of about $14 billion this year in ETFs, but the loan ETFs have been in a consistent state of outflows as you've seen investors really recalibrate rate expectations. So I think you're seeing a couple different things now. Number one, if you look at BKLN, you're starting to see investors realize, hey, this is more than just a rising rate story. There's good income here. There's relative value versus traditional high yield, where you're actually seeing loans out-yield high-yield bonds by about 40 basis points, which we haven't seen these levels since 2013. And then you're senior secured in the capital structure. So seeing that, and then also you have a little bit more not clarity around what the Fed's next move is going to be.
All right. Well, speaking of the Fed, there has been some turmoil in the repo market, Rachel, as you know, and the Fed has had to step in. In fact, a former Fed official says he is worried about what's going on right now. Narayana Karchalakota writes in Bloomberg Opinion that what's hard to understand here is how money markets will respond to future shocks. The design of regulation has disrupted some of the system's most basic functions. The people who oversee it all should be far from sanguine about what the repercussions might be. When you look at what's going on, do you see any effects on the ETF world?
I mean, so far it's pretty limited. There is one ETF that I came across that does buy repo agreements. That's run by a firm called ClearShares and has the ticker OPER, but not really seeing kind of any significant impacts on that or kind of elsewhere in the ETF market. I think where there's really kind of the rubber could hit the road is when it comes to sentiment. That's something that we kind of like look at to the repo market, and the fact that whether banks can access or not access funding easily as something that kind of drives people feeling good about kind of generally putting their money to work. So if we do see some continued problems in the repo market, that could ultimately rebound into markets more generally and then ETFs.
Tim, what would be your canary in the coal mine when you're looking for some kind of spillover into ETFs?
Well, we haven't seen any right now. So the big thing, as Rachel hit on, is just confidence.
Okay. And I don't know if you guys have heard, but there's some big news in Washington this week. I want to get everyone's take on it. Yeah. The Etf Rule Change. It's being discussed right now. What's being discussed, Rachel?
Yeah, so I mean, this has been a kind of decade in the making rule that would kind of basically level the playing field for ETF issuers and kind of streamline their path to market. So for new issuers coming into the market, they would be able to skip over this whole exemptive relief process that slowed down funds from getting approval and getting to market and just come out under the rule. There's also a few kind of like more wonky changes to do with kind of fixed income and making those easier to come to market. But basically, it's about kind of bringing the ETF industry kind of into the 21st century.
And speaking of that, one of the rules is to streamline launches. So I thought back in the day when I heard about this, oh my God, there's going to be like tons of launches. But something has happened. There's a freeze. People are not launching anymore. I think it's the fee war and it's brutal out there. How are you with launches? Do you think this will catapult launches, or is it naturally just too hard and launches, you think much more carefully now before launching?
Well, you have to have a client need, right? And I think that's the most important. So speed is great, but you can't overshadow demand. If you look just this week, Invesco launched a series of 9 different municipal bullet shares ETFs. And really the catalyst for that launch was a lot of the feedback we were receiving from clients that they were having trouble sourcing individual municipal bonds, that it was costly, time consuming to build a diversified portfolio or a ladder. So a strategy like that where there's demand, I think makes all the difference. Speed's important, but demand trumps.
Got to solve the problem first. All right. Our thanks to Tim Urbanowitz of Invesco and our very own Rachel Evans. Now, coming up, Phil Back and Tyrone Ross from Exponential ETFs are joining us. The pair attempts to bring a new generation into retail investing. And one fund that caught our attention this week, the ETF MG Alternative Harvest ETF, you know it as MJ. It hit a record low as the fallout from vaping-related illnesses in the U.S. continues to snowball. A reminder, you can find that chart and all the other ones that we feature right here at GTV Go on Bloomberg. This is ETF IQ. I'm Scarlet Food. This is ETF IQ. Let's take you through the ETF Lifecycle, which has 3 main stages, and it all begins with the filing. State Street registers a suite of 5 ESG funds. These funds will cover corporate bonds and large cap equity strategies, and full disclosure, track different Bloomberg indexes. Bloomberg LP, the parent of Bloomberg Television and News, creates and distributes indexes. Now, step 2 is the launch. Nuveen adds another ESG fund to its stable. Its high-yield corporate bond ETF begins trading this week under the ticker NUHY. And for some, the final stage is liquidation. The Advisor Shares New Tech and Media ETF will soon shut down. The actively managed FNG launched in 2017 and saw its assets fall from more than $50 million to some $10 million. It costs 85 basis points. Let's get passive aggressive and track the tensions between active and passive investing. Passive already has the upper hand when it comes to fund flows and costs. Now, one ETF issuer is taking it a step further. Exponential ETFs is building out its advisory services by launching a financial education initiative in its hometown of Detroit. Leading that effort is Tyrone Ross, and he is here with us along with Exponential founder and CEO Phil Bach. Welcome back, guys.
Hey, thanks for having us.
Great to see you. So, Phil, let me start with you because you guys are home of the RVRS fund, which is the reverse cap-weighted U.S. stock fund. How do you go from selling that to financial education in Detroit?
Well, it's a part of what we do, and what we're trying to do is counter the fact that the incentive structure in a financial services industry is tied entirely to the amount of assets that you have. That's typically how people get paid. So what you're left with is a system where people with the most amount of assets, like institutional investors, have the most amount of resources and help, and people with the least amount of assets, or people that are not even in the industry or are unbanked, are left with no financial advice, no financial literacy and education. We want to counter that.
Tyrone, I want to bring you into the conversation. You're an advisor who uses some ETFs. You're familiar with it, but now you're working with an ETF issuer. What's driving your participation here?
So, again, having grown up in a financially illiterate household is very important to me. Also, when you look at the statistics that are out there, right, the American Public Education Foundation just put out a press release saying that lack of financial literacy is a crisis in this country, right? And I know that firsthand. But more importantly, it's time for financial services, especially financial advisors, to get in front of this, to get into schools, to get proximate to people in need. And I want to lead that charge.
Now, how long into the education program do you think it'll be before you bring up ETFs? Because we talk a lot about how it's an accessible investment for those who are already in the market. How accessible a concept is it for people who are getting into the market?
Right. Well, I'll make it very clear that will probably be the graduated class. What we want to do is really start boots on the ground, starting in elementary school, right, undergirding teachers and helping teachers. So this will be a full-blown out financial literacy and education. So financial literacy to get into schools, education for the working class people, that may be more of a conversation for ETFs, and for teachers that are teaching it at a more graduated level. So there'll be levels to how we actually institute this and what we actually speak to, but I'm certain ETFs will be at the end of that, but it will be in the discussion.
So it's clear what this project means to both of you, Phil. How did you meet up with Tyrone? How did you hook up with him on this project?
We actually met through social media, and then we ended up being on a couple podcasts together. Eventually, we were at conferences together, speaking on stage. And it really blossomed into now a partnership and a friendship. And I think it's really indicative of where we are in the financial services space, where the asset management firm of the future does not look like the asset management firm of the present. And it's going to take time. But these types of initiatives, these types of relationships, the type of marketing that we're doing, being focused with online and building our authenticity and our brand, that will pay off in the long run.
Yeah, something that the smaller shops have to do that the bigger shops perhaps are a little slower to do. Tyrone, speaking of social media, you have a pretty big presence on social media. You've got yourself a lot of engagement as well. You post these regular post-workout Periscope videos, and we have a couple here. Let's pull it up right now to show everyone just a sample of what it is that you post.
The first asset class in history led by retail. Yes, the first asset class where you don't need a broker and you can do it yourself and you can buy $5 worth or $20. That's all great once you learn and you understand. But most people in this country are dying for anything to pull them out of their financial peril. Trust me, my parents still play the lottery.
And of course, it makes sense that you're doing this post-workout because it's part of who you are. You were a 2004 Olympic trials qualifier in the 400 meter. It's very much a part of your persona. Not everyone can pull this off, this authentic version of themselves on social media. How would you advise someone in this financial space who wants to do that and wants it to be an effective way of bringing about information?
Tell your story. I think you have to be authentic in an era now where everything is about fintech and robo. You have to humanize yourself. You have to put yourself out there so people can engage with you and understand that there is something beyond the suit. And for me, I don't hide behind it. I had a very difficult life. And I mentioned there that there's always this narrative of the lottery is bad, and the lottery has kept a roof over my family's head, right? A scratch off has fed me, right? So I tell that because I need people to understand, as someone who comes from that background, right? But also a financial advisor, I have to walk that fine line. And I think by telling the story, I'll encourage other people to tell their own.
Phil, this project is starting in Detroit, but you may expand it nationwide. How will you measure its effectiveness?
So Detroit is the proof of concept, and if we can have an impact and we can help people, again, with the very basics of budgeting, saving, what is an APR, what do you need to look for? If we can really make an impact, then we can build it out nationwide. What we're really trying to do is build a community of people in the financial services industry that want to get involved with us and help. And if anyone's watching, they want to get involved, reach out to Tyrone, reach out to me. We're trying to get people together so we can get the message out there and do the right thing.
All right, Phil Bach and Tyrone Ross from Exponential ETFs. Great to see both of you guys.
Thank you.
Now coming up, 5G being touted as the next big thing for the world's mobile network. We take a look at an ETF that seeks to benefit from the technology tied to certain companies. This is ETF IQ. I'm Scarlet. This is ETF IQ. For every ETF that offers exposure to a strategy, others are quick to follow. Sometimes it goes beyond strategy, and it's a philosophy. Beyond Investing is a firm committed to building portfolios that are animal cruelty-free and environmentally conscious. The CEO, Claire Smith, is here with us now. Before we talk to her, Eric Balchunas is going to give us the drill down into the firm's new fund, Vegan, VEGN.
Thank you, Scarlet. Yeah, this is an ETF I think a lot of people have heard about, the first vegan ETF. And you said it, it's animal cruelty, but also environment. So it's not totally just about animals, but it does screen for animal testing, animal products, but also things like military and fossil fuels, right? So here it is. It's very small still, very new. 60 basis points is the fee, which I think we're going to dive in a little bit in the segment. And let's look at the holdings. I think that's what's important here. Now, I kind of was expecting to see Beyond Meat right at the top. It's not. It's more of an exclusionary where they go and they look at 500 stocks, the largest 500, and they pick out stocks that don't meet the criteria. So what you're left with, though, are some big blue chip stocks. So it looks a bit like the S&P. Let's look real quick at the biggest excluded sectors. That's the big deal here. You are going to be underweight healthcare and underweight staples and overweight tech. So Scarlett, the question here is this going to be something you add a little bit to or to replace your whole equity slug? And that's going to be the challenge for this fund.
Right. How do you position it in your portfolio? Still with me right now is Claire Smith, CEO of Beyond Investing. Claire, before we get to that question, I noticed, as Eric showed us, that healthcare has the biggest exclusion. Is that because of animal testing?
Yes, it would be because of animal testing, exactly.
Okay, makes sense. And in terms of some of the exclusions, I know that Eric was digging through the names, and Eric, there are names like Disney and Berkshire that were not included.
Walmart. Yeah.
Yes.
I mean, the list kind of goes on here.
Yeah, I mean, Disney in particular, I think people think of Bambi and like animal lovers, but that's out, right? And then you've got Amazon out, you've got Berkshire out. What are some of the reasons? Like, let's go over Disney and Berkshire. Why are they not in it? Or in Netflix?
Okay, Disney, in addition to the same reason as Netflix in some senses, which is that they are commissioning films which would be using animals and actors, which is exploiting animals in some sense, obviously not as bad as raising them and killing them, but still exploiting animals. But in addition to that, Disney has captive animals in its wild animal kingdom. So effectively that's a zoo. And we would take the position that animals should be out in the wild. With respect to Berkshire Hathaway, you mentioned that they have Dairy Queen as a big brand and also a shoe store, shoe manufacturing company
that uses leather,
which obviously is using leather. So it's everything throughout the entire supply chain of animal products that we are excluding.
Now, in the vegan prospectus, you say that for every $1,000 invested, 13 animals will be saved. How did you get to that number? How did you calculate that?
Yes, I think we suggested in our fact sheet that they would be spared. Essentially what we did was we looked at the amount of animals that are killed around the world, the vast majority being within the area of meat, fish, dairy, all of the food items. The animal testing is a much smaller amount, so it adds a little bit to that. But we essentially divided that number by the market cap of our exclusions. So essentially, those companies that we're excluding are responsible for those animals being killed, and so it's a direct relationship between the two.
Now, we sparred a little bit on Twitter. I think one of my questions about this product is I'm expecting to see it be like a plant-based economy theme ETF that goes hardcore towards smaller stocks that do this thing.
Beyond Meat, for instance.
Right, and you just allocate 2% to it. You're basically trying to replace somebody's core equity position. That's a tough to dislodge Vanguard especially at 60 basis points. What was the logic behind that decision to design it this way?
Okay, so I mean, I'm an impact investor myself, and so I'm always looking for where the biggest impact can be made. People's default is the S&P 500. They put the majority, especially in the US, they'll put the majority of their equity holdings into the S&P 500. We know that there's some $9.9 trillion that are benchmarked to the S&P 500. How many vegans are there in the world? As a percentage of the population, it's going up 1, 2, 3, 4, 5% maybe. There was a recent study which suggested 6% of people self-identified as vegan. That's 6% of that 9.9 trillion that really should be thinking about these types of exclusions and imposing them across their portfolio. So we're giving them a ready-made package. We're doing all the hard work, going through the index, cutting out all the things that they should potentially disagree with. And that, we think, is going to have a big impact.
Okay, so very quickly, you are animal cruelty-free, you're environmentally conscious. What's your next fund going to be? If you've already kind of done the same thing for the S&P 500, what's your next act?
Oh, we have lots of ideas. We can certainly do the same thing in different regions. We've already done Europe. We're doing global now, and we may well have a partner for that in terms of a launch. And just coming back to Eric's point, we have looked at a global vegan thematic basket, but we don't think at this point it can be created as an ETF because those stocks are too small. They have far too low liquidity. But we are looking to create it as a different, much lower cost, administrative cost offshore product initially.
So to be announced then. Claire Smith of Beyond Investing, thank you so much for joining us.
Thank you.
We like to say the ETF industry has something for everyone. 5G networks are coming soon, so of course there's a fund hitching its wagon to the mobile network star. The Defiance Next Gen Connectivity ETF touts itself as the first 5G fund and as such trades under the ticker 5G. It targets companies whose products or services are tied to the development of the 5th generation network technology, the world's next mobile network. 5G could end up being 100 times faster than its predecessor, allowing for more connections and transforming basic industries, virtual and augmented reality, and the Internet of Things. This is a fund that's heavily weighted in the US and is mostly large caps. It uses a tiered weighting system that divides up sectors such as cellular networking, cell towers, and hardware. With some 70 holdings, top names include Analog Devices, Skyworks, Marvell Technology, Nokia, and Xilinx, all companies the fund hopes will be instrumental in the 5G rollout. So far, its potential has outstripped its performance. After launching in March 2019, the fund has failed to keep pace with the broader market. 5G has about $115 million in assets, with an expense ratio of 30 basis points. It gets a green light in the Bloomberg Intelligence traffic light system. And that does it for Bloomberg ETF IQ. Be sure to catch us each Wednesday at 1 p.m. New York time. This is Bloomberg.